Hi everyone, Donna here with Bookkeeping Made Simple, and today we're going to talk about the difference between cash accounting and accrual accounting. I realize this is about as interesting as watching paint dry, but it is important for you to know for your business. And so I really want you viewers to understand it. As always, of course, if you enjoy these videos, please like, share, and subscribe. Hit the red notification bell if you're on YouTube. We are on Spotify and YouTube, and we are really excited about it. So, and with that, I'm just going to jump right in. There are two ways of accounting. One is considered actually more accurate than the other because it smooths out the income. And it has a lot to do with how revenue is recognized in your accounting. So the first way is cash accounting. The second way is accrual accounting. As you may kind of guess from the names, in accrual accounting, we accrue certain expenditures, and then they are taken care of later. So in accrual, we're going to have accounts receivable, accounts payable, inventory, things like that. However, in a cash business, we'll probably have inventory, but we might not have receivables or payables. The reason for that is in the way that the revenue is recognized. Cash basis accounting records revenue and expenses when cash actually changes hands. So in my own business, we do accrual accounting. So in my own business, I can generate an invoice. I have very little accounts receivable, but I do have it. So I can generate an invoice and immediately recognize that income, even though the cash is not in my hands. In cash basis accounting, the revenue is recognized when you get the cash in your hot little hands, so to speak, as my mom used to say when I was growing up. So we want to make sure that you understand the difference. And so cash basis, both revenue and expenses are recognized when cash is actually received or dispensed. Accrual accounting records revenue and expenses when transactions occur, but before money is received or expensed or dispensed. So in accrual, like I said, you generate an invoice. You may have it be net 30. It may take some time for the money to get to you, but you recognize that income when the invoice is generated, when it's earned. And when it's earned may not be the same as when you receive payment. The same thing for payables. If you are running accrual accounting, then we need to see all of your accounts payable. So when your phone bill comes in, we would need to see it to enter it. When your insurance bills come in, we would need to see it so we can get it entered as a bill. And then we pay them on the due dates. And by we, I mean the client, because we don't actually pay bills. But that's when we recognize these expenses. We also, another difference in accrual accounting versus cash accounting is if you have cash accounting and you have, you pay an insurance policy, for example, for a whole year out, which I do, then that's just one big expense that's recognized when the cash leaves your company. If you're in accrual accounting, we then put that year's worth of policy premium into an account called prepaid insurance, and we spread it out over the year. Don't do that in cash accounting because, again, we don't have to do prepaid. It's all recognized when the money goes out. Okay. The accrual method is considered to be the most accurate because everything kind of smooths out like that. So it has a more accurate view of a company's health. We include accounts payable and receivables. It is the most commonly used method, and in fact, that's the only method I have been taught in accounting school or in business school. It smooths out earnings and expenses over time. Cash basis is usually used by much smaller businesses, and it's typically used for businesses that automatically, like I have used restaurants, maybe a snow cone stand as an example of you pay at the time you receive the service. So if I'm going out to eat, I am paying for my meal at the time that the restaurant is providing the meal. There's no lag, so it makes sense for a restaurant possibly to be on cash basis. And it's typically used by sole proprietors and smaller businesses because it's a little bit easier to run that, but it is not considered the most accurate. Again, using the prepaid insurance as an example, you use up your insurance policy over the course of 6 months or 12 months, however far ahead you've paid your policy. So we want to make sure that we can see that there's 6 months or 12 months. Same thing with things like phone expense. I have seen clients have 2 months worth of bills in 1 month, or they've paid it twice in 1 month just because of the length of the month, or they, took advantage of the grace period and now they've paid it twice in a month. We want to see that spread out over each calendar month so that we can do the budgeting and forecasting. That's the biggest difference. It really, really gets, we can get into the weeds in it, and it probably will, because I want it to be understood, but that is it in a nutshell. Okay, so in accrual accounting, like I said, you earn the revenue, you provide a service, you sell some goods, and you generate an invoice. You may not get paid at the time that invoice is generated. However, you have a reasonable expectation of getting paid if you have done your due diligence and you have made sure that you checked credit before extending credit. But typically, money is accounted for before it's received in accrual accounting. Again, it could be 60, 30 or 45 or 60 days before the money comes in. So we want to make sure that that's all accounted for. And in accrual, we account it when the funds are earned, when the revenue is earned. Now, that smooths things out because you may have one customer that pays net 30, you may have another one that pays net 60, and you may have a huge chunk of money that comes in all at once for something that you did or sold 3 months ago. So we want that revenue to be recognized as it's earned, so to speak, even though the money hasn't come in. Same thing with expenses. We want to make sure that money is recognized as the expense occurs, which is not necessarily, but often is, when you make the payment. So utility payments, we want those to sit in accounts payable because we want to be able to figure out what your payables are. So when you get your bills, we want to put those into accounts payable so that then, one, we can schedule that in advance, okay? We can help you walk through how the accounts receivables, payables are going to be going out so that cash flow is more easily managed. In cash accounting, all of this is recognized as the money goes in or out the door. So the only way I could do cash accounting, by the way, is if I never ever extended credit to anybody. And I do sometimes extend credit, or I do sometimes continue to work with a client, even though they still owe me money from a previous month. Cash method, by the way, is also typically used for personal finances. Accrual accounting is almost never used for personal finances. And what I mean by that is, as a household manager, I guess is the best way of putting it, I only worry about cash flow. So I'm only looking at the cash coming in, the cash going out. Received a paycheck, I paid my bills. Typically, that's how households are run. So when that happens, well, typically it's how households are run. Households are basically run on cash flow. So, like I said, you receive your paycheck, you pay your bills. Businesses, of course, are an entirely different creature. And because of that, we record these expenses when the bill comes in, even though it may take us 30 days to pay the bill. We want to see what the actual we want to see what the payables are, and that will help us with budgeting and forecasting in a way that doesn't really apply to households. And this is a much more accurate picture of the business, especially over the long term. By way of an example, a company might have sales in Q4, which is usually the busiest time of year, especially for retail, right? Because that's when Christmas is. Christmas and Hanukkah and Kwanzaa and all those winter holidays that we celebrate are in Q4. So I'm using that as an example. So let's say you generated a lot of revenue in Q4. Or let's say, and this is another really good example, attorneys have to have a trust account. It's called an IOLTA trust account. They then receive a retainer from their clients. They have not earned that retainer yet, but their client has prepaid for services. So then, as the attorney generates billable hours, they can recognize that revenue and use their trust account to pull money over and put it into the operating account and then recognize it as revenue. In this case, the funds came in first, but revenue recognition did not occur till later. Okay, so real estate is the same way. They can earn the money, but a lot of it has to be kept in a trust account, and title companies are also the same way. The money comes in first, it's kept in a trust account, it is kept completely separate. By the way, trust accounts are not shown in the books. They have their own set of books for trust accounts. And then when the revenue is recognized, then that money transfers from the trust account to the operating account and can be recognized as revenue and used. So that's an example of prepaying for services. Another example of paying as you go would be a home builder. They're not going to put out $500,000 in supplies and labor without getting paid as they go. So what they will do then is they will create an invoice for the entire project. And those invoices are probably going to change over time. They're going to create an estimate. They're going to include all of their supplies, what they expect to pay in supplies and labor. And then they're going to do what's called progress billing, which means that, we dug the basement, we put in the footers for the foundation, we're going to bill for that. And they will take that estimate and they will, there's several ways of doing progress billing, but they're going to then bill for the work that they've done, because now they can recognize the revenue. They can recognize the revenue from the very beginning because they're invoicing it, but they're going to get paid a little bit of time as they go. Unless their customer has taken out a construction loan, they're probably going to just pay as they go. But maybe even because I've never built a house, so I don't know. I've done a lot of I've done books for home builders, but having never actually built a house, I don't know if that's from the construction loan or if it's just from the, I would imagine it's a construction loan. So the revenue is recognized at the beginning of the project. The money comes in a little bit at a time due to progress billing. Accrual is often more complicated than cash. Cash is really, really simple. That's why most households use it. However, accrual, even though it's more complicated, is also more accurate. So let's say we have a client who has a big sales month in the last quarter of the year. If they record that in cash basis, that would mean that the cash has already come in the door, and that's why they're recognizing the income. If they record it in accrual basis, we might be able to see that money come in. Let's say all the sales were in December, but the money doesn't come in until January. Well, we're still going to recognize the sales in December in accrual. Now, one of the ways that's beneficial is that that same revenue is going to be kind of expected for the following quarter. So quarter 4 may be big, and we want to recognize it as big, but we don't want to recognize that revenue in quarter 1 because now it throws off all of our forecasting and all of our budgeting. We need to be able to see, and this is especially important if you have investors. They want to be able to see the ups and downs of the business and what they should be able to expect for revenue. So if you have $1 month, you want to make sure that that revenue is recognized in the month in which it was earned. And that way, those earnings kind of smooth out. Investors like to see that. They want to know how much they should be expecting as far as return on their investment. They also want to make sure that they are we don't want an investor to think a company is unprofitable when it actually is profitable. And that is where the revenue recognition comes into place. Revenue recognition, by the way, is actually very complicated. Especially in some businesses more than others, but it can be very, very complicated about when to recognize the revenue. And we want to see, again, everything kind of smoothed out. So I would rather know that a client is making $250,000 a year in their business rather than 1 month with 100,000, the next month with 20,000, and then it's up to 30,000, and then it's down to 10,000. That doesn't make investors really happy. They want to see that evened out over time. And the best way also, like I was saying, accrual also allows for unearned income and prepaid expenses. Unearned revenue, prepaid expenses are accounted for in the accrual method. Also, in the accrual method, there are a lot of accounts for work in progress and cost of goods sold. Now, cost of goods is also going to be in cash. But again, in cash, we're not accruing anything. We're just paying for things as we go. It's kind of the difference between paying out of your checking account versus paying out off of a credit card. As far as your expenditures, we recognize the expenses in cash as they are made. So there's no point in having, I mean, we'll account for things in cost of goods, but we're not going to be doing a lot with work in progress because we don't accrue anything. So if you build cars, my brother-in-law used to build Jeeps for Moab. This is a really good example, actually. My brother-in-law used to build Jeeps for Moab for the, the crazy going up a 90-degree cliff kind of a thing. I haven't been wheeling with him, so, or with my sweetheart. So I don't know, but they used to build Jeeps for King of the Hammers and that kind of racing. If you don't know what it is, feel free to look it up. I don't know much about it, except that I do know that he used to build these. So he would then charge a customer whatever it is he was going to charge, and I'm going to use 100 grand as a round number. However, he could not recognize that revenue until the Jeep was built. He might receive the money early, he might receive the money later. Usually he would receive the money early so that he had it to be able to pay his expenses relating to this particular project. Now, under accrual, we would have expenditures, or we would have a balance sheet item for work in progress. Work in progress stays on the balance sheet. Okay, so we would have a balance sheet item for work in progress, and we would put all of those expenditures to work in progress. When the Jeep was sold is when we would recognize that as cost of goods sold, and that would be applied to the revenue. Okay. Accounting has a thing called a matching principle. So we want to match your revenue to the expenses that you had to have in order to gain that revenue. And that's all under accrual. If it was cash, okay, he would recognize his income as soon as he got the cash in his hands. So as soon as a client came in, prepaid for a Jeep, even though he hadn't earned the money yet, he has the cash. So he would recognize that revenue. Well, it might take a year to build a Jeep because it's all custom. So now he's got revenue in January, and he's got expenditures every month that all the months after that are going to look like he has a loss when it's not true. Okay, so if it takes him a year to build a Jeep, we want to recognize that income that he received prepaid over the course of the year to even that out and show that these expenditures went with this revenue. Okay, cash basis does not allow us to do that. And also, cash basis does not do much to help us project how much staff we need. Do we need to hire more employees? Okay, so if he has 2 or 3 projects going, then he's going to need to hire people to help him because he can't do it all by himself anymore. But we need to know what the revenue is, how much we're going to recognize month after month, even though, like I said, he's already got the cash. But we need to know how much we need to recognize month over month so we can budget for new employees. It is, by the way, accrual method is required for any company that wants to have an initial public offering, or if you're going to be initial public offering, if you're going to be traded on the stock exchange, you have to have accrual method. Accrual is also required for audited financial statements. Because of the accrual, we have to be much more careful about auditing. And it is considered generally accepted accounting principles by the Financial Accounting Standards Board, the FASB. Cash basis is not acceptable under GAAP. And if you didn't, just to avoid any jargon, GAAP, G-A-A-P, is generally accepted accounting principles. You'll hear me say that a lot. Cash basis is not acceptable under GAAP. So I try to keep all of my clients on accrual, but they kind of struggle with that. Some of them. A lot of our clients are cash because they're very small businesses and they're not receiving prepaid money. They are receiving revenue at the time that the revenue should be recognized. And so we can do the same thing with their expenses. Other of our clients really need to have accrual. So, and that's kind of what the difference is. It's not, it sounds complicated and people get very concerned about it, but it's not as complicated as it appears. Publicly traded companies, accrual is required. So that is basically the difference. Like I said, it is kind of it's kind of interesting as watching paint dry. I try to make it a little bit more interesting, but it's not a sexy subject. I kind of wish it was. I enjoy it, but it's not the super sexy subject like tech is. You know, even financial technology. It's not sexy like AI, but it is the most important part of your business, is to have a good accountant who is willing to work with you and is willing to explain things to you as you go. So with that said, I'm going to go ahead and end this video. I hope this was helpful for you. And if you have any comments or questions, please feel free to comment in the comment section. I do see those, I do look at them, and I'm very interested in what my viewers have to say. So if there's a particular subject, excuse me, that you would like me to cover, just let me know. And if I can, I will do a video on that. And I will talk to you again soon.